WPP share price, which has collapsed. Yeah, and again, they had a profit warning. Greater pressure there on the new CEO to come in. What WPP, certainly with WPP Open, has made a bet on is it can target the SME advertising market and look for that to fuel growth, because ad agencies haven't really been able to break into that market. With Mark Zuckerberg saying, we can actually, if you give us your credit card details, we can essentially produce your ad, we could distribute it sort of across platforms, we can run it from start to finish. That message is not targeted at the CMO, it's targeted at the CFO and the CEO. Many Western companies, particularly US companies, have tried to break into the Indian market and have not found it as easy as they thought. Either scale back their operations or have, like Disney did with GeoStar, have become a minority partner sort of within there. If you look at the results that come from the online companies, you're probably looking at maybe around 65-70% of all global ad spend being now SMEs. It's not just Google and Meta, but it's also, for example, the e-commerce retailers on platforms such as Amazon. And there, that spending is increasingly disconnected from what you would think normal economic conditions, because quite frankly, for those sort of smaller companies, if they are not on the internet, if they're not advertising on the platforms, then consumers just, they just can't buy their products. It's essentially life or death for them.
Ian, good morning and welcome to Sell Side Conversations.
Thank you very much, Catherine. It's a pleasure to be here.
Well, it's my pleasure and honor to have you here. So, Ian, I was going through the LinkedIn profile. You've been an equity analyst and you were around in the .com era. You're also a war historian. You're a media analyst. You're a guy who wears many hats. Can you just sort of give us a quick introduction about your background?
Yeah, sure. No, I mean, it is true. It does feel like a lot of hats. So absolutely right, Gautam. I was an equities analyst for 20 years in the London financial markets. I covered sort of the media and tech industries sort of increasingly on a global basis. I was twice City AM Analyst of the Year across all sectors during that time. And then 5 years ago, I set up my own consultancy, an advisory business, Liberty Sky Advisors. And the whole idea of that was really to provide services to firms across the media and tech spaces, not only covering what's happening in sort of those sectors as a whole, but also linking it in with what's happening with sort of wider global macroeconomic and political trends as well, to give, as it were, the whole picture. And as I said, I've been doing that 5 years. As you also mentioned, I'm a historian by training and more recently a war historian. So yes, quite a few things to do.
Oh, wonderful. So, Ian, tell me, you've been a media analyst for about 20 odd years. What are the top 2 or 3 trends that you've seen either in consumer behavior? I mean, obviously, the technology has evolved and, there's been phase of internet, mobile, social media companies. That trend everybody knows. But what are the 2 or 3 trends in consumer behavior that we have seen over the last 2 decades?
I think what's quite interesting is the way I always look at things is that basic human nature doesn't really change, but maybe the ways in which it's expressed actually do. So what I would say is that we are still sort of one trend is that video content is probably more dominant than it was when I started in the industry back in 2000s. In 2000, newspapers still had quite significant reach. The same with print generally. What you're seeing now in terms of the distribution trends is that it's been shift over to more and more video consumption. I'd say aligned to that as well, again, probably sort of a key factor here, just for the development of mobile phones, is the usage of media used to be very much limited to how long you're in front of a device. Now, that was particularly the case with television, that you could only watch it when you're in your home. Whereas now, of course, you can watch that content on the move. So what you could argue is that the amount of addressable time in terms of where consumers are exposed to media has also sort of increased dramatically. I'd say probably also as well, a third sort of trend that I think over the past 25 years also seen as well, it is almost, let's call it a confusion amongst people. They have so many sort of data sources that are coming in at the moment. And you see this in areas like fake news and people's trust in media that almost in a way it becomes too much for them. And so there's an interesting question here. Whereas at the moment we're in an era of proliferation of media that only looks to be getting more, whether at some point there becomes a backlash against that.
Gotcha. So yeah, so those are trends that one is seeing over the last couple of decades. Now, if you sort of delving on this further, in the media industry and media and advertising industry, what are the top two or three developments that you're seeing? It could be either in mergers, acquisitions. It could be, businesses on a business level. What are you seeing? Top three or four things on a macro level.
Well, I would say, I mean, there's so many things which are going on at the moment. I think a key thing here, probably the key driver, both over the short but also the medium to longer term for what happens in media and tech, is just the development in AI. And I really mention that because the amounts of money that are being spent in investments by the major tech companies in particular are eye-watering amounts. You're looking at well over $1 trillion now, according to some estimates. Now, the point being with that is that from an investor standpoint, investors want a return on that money. If you're a firm, normally the way that you generate a return is either by increasing your revenues or cutting your costs. For the tech giants, this is not really a cost-cutting exercise. They will need to recoup that investment really through revenue generation. And given the scale of that sort of revenues that they will need, what that likely means is that, quite frankly, we're going to see a lot more aggressive fight for money in the media and tech spaces. And I think a key area there will be advertising. You can already see this, and this leads into what I would call the second trend that you're seeing, for example, with YouTube talking about YouTube is TV, aggressively sort of seeing sort of parts of the tech space move into what are really the last pots of advertising money. And that is TV advertising money, around $170 billion global advertising market in 2024. So that fight for money will increase. I think on a consumer standpoint, what you're also seeing here as well is, whereas let's go back around 5, 6 years ago, the story was very much driven by sort of increasing reach amongst the global population. And this was the case for things such as streaming services, for example. What you're now seeing is a shift really to saying, how much money can you extract from each consumer rather than necessarily growing the overall consumer pie. And I think sort of what's caused that is particularly if you look at a sort of just a global landscape, obviously China is very close to very many Western media firms. India, yeah, has proven to be sort of not so easy for a number of companies as well. There seems to be an increasing focus back on, let's call North America, Western Europe, sort of markets to grow revenues. And given the fact that those overall consumer markets aren't growing that much in terms of population, what that means is you have to focus very much more on the ARPU side, the amount of revenue that you actually pick up from each consumer.
So got you. So what you're saying is China and India are not the major markets for a variety of reasons. So the focus is mostly on North America, Europe as markets for advertising revenue and things like that. Is that a
Yeah,
fair summary?
it's a fair summary. I think what you've got here, and not just for advertising, also as well for subscription revenues. I mean, there are major differences between China and India, obviously. I mean, yeah, China very much has its own media ecosystem. Yeah, obviously the government there is very, very wary of allowing sort of Western companies to operate in the country, and you've seen that sort of across a variety of industries,
Ah,
internet. You look at also as well films, but also consider the raids that you had by the Chinese authorities on WPP, for example, and the impact on their business there. With India, I think it's slightly different. Obviously, sort of there is a sort of decades long pattern here of strong Indian firms sort of dominating their home markets. I think for many Western companies, they came into India thinking population of over a billion, growing middle class, strong economic growth. On paper, they look very attractive markets. And I think, sort of putting my historian hat on again, it's a classic example of how maybe sort of many Western executives just don't understand some of the nuances around the Indian market, its history, of just how things are developed, just not just history in media and tech, but just the general history and what's happened since independence and the nature of the political debates there. That India is not the easiest market for non-Indian companies to necessarily break into. And of course, it's a very low ARPU market as well, which has got implications here as well. So I would say that for many of these of companies, particularly in areas like streaming, 5 to 6 years ago, they had as it were, a grand plan as to how many subscribers they could get. Yeah, that very much has changed. I'd make one sort of final observation here as well, and
Sure.
I think it's particularly with the mindset of Hollywood, is that if you look at many of the US media giants, and indeed, if you look, for Netflix and they're sort of thinking that sort of influences the tech companies as well. Certainly with Hollywood, many of the executives have grown up in a background that was film. And of course, in film, historically, certainly since World War II, American films have dominated of the global film market. And it really has been a market that essentially hasn't really had many borders. And I think what happened was they took that attitude into particularly the television area, thinking it would be the same. And of course, it hasn't been.
Absolutely. So you just touched upon the AI, wave that is sweeping across the world. Do you think new winners will emerge, or it's going to be the same old boys who will sort of lead the pack? What is your thought on that?
No, I mean, it's a really, really good question. I mean, my general feel is that, scale, you're either going to get two, two, let's call it, sort of potentially bipolar opposites. The first sort of scenario is that the tech giants continue to dominate, and not only do they continue to dominate, but they take of a vastly significant increase in share of the pie. I go back to this point before, that to fund the investments in AI and to satisfy the financial markets, that these companies can generate the returns they need. And you only need to look at what happened in the US stock indices last week, where you see of $800 billion wiped off the market cap of the major tech companies. They will need to seize control of substantial of streams of extra revenues. The obvious one, as I said before, was the TV advertising market, but also as well, potentially that could encompass other areas of the advertising market, including the agencies. Mark Zuckerberg has talked about allowing advertisers to essentially go from start to finish just using Meta. That is an existential threat for the agency. So that is one scenario, that you see the tech companies becoming even more dominant within this space. The other scenario is that essentially the spending on AI is a bust. It effectively doesn't really go anywhere. It doesn't lead to the returns that people are thinking. And then that again has got some of existential threats for those tech companies. One, because investor confidence in those companies would be very, very severely dented, and that by itself would have an impact. But second of all, as well, for their existing business models, it would open them up to potential challenges. There is one other thing also as well that need to consider with AI, and it comes back you mentioned at the start that I was an analyst during the dot-com bubble, and I was. I think there was one, besides the financial angles and the valuations, there's also one critical difference here between what we're seeing with AI now and what happened back then. And that is,
Okay.
AI now is seen central to the superpower struggle between the US and China. And why
Oh,
that's critical is that certainly for the US administration has effectively outsourced its AI capabilities to its tech giants. And therefore, as long as they believe that AI is central to this struggle, they are likely to do anything that they can to make sure that these companies are able to continue to spend, and also as well do not fall behind in the race for China. And that's an important consideration that often doesn't get mentioned.
So it's more geopolitical in sense that some of these, it's in US's interest that some of these tech giants or tech companies sort of remain viable and are, have a healthy business model.
Absolutely. And you can see this also as well, particularly in the trade negotiations that you've had with the European Commission. I mean, the Europe wants to bring in legislation that would restrict the use of AI, but also as well, would hinder the capabilities of the tech giants more generally. The Trump administration came and said, we actually see that as a red line when it comes to trade talks. And if that's the case that you're going to punish US companies, then we will take action with regard to general trade. So what's happened is the tech companies, the US tech companies, have very much now become aligned with the administration. The administration is very much pushing their interests to countries across the world. I'd say though that one thing with this is, which is interesting, is this is not, as it were, it's not a blank check. A very interesting example here is you look at Australia that has
Mhm.
introduced, quite a few measures that have seeking to sort of restrict the activities of the tech companies, bring restrictions, particularly when it comes to minors. The reaction of the US has been quite sort of muted when it comes to threats against the Australia. Yeah, you could argue that essentially the fact that Australia has critical minerals for the US and also as well sort of is in a strong strategic position means that the US is taking a laxer line than it is with Europe that doesn't really have those. So yeah, there are all these various considerations that are very much in play here when it comes to AI. But I think the general thing to say is that certainly AI has become bound up with the geopolitical struggle that we're seeing at the moment.
Got you. You mentioned an interesting example that when you said Meta may just sort of instead of being a media entity, it could also be on the creative side. So it could sort of offer services across the spectrum, right, from creative to media. Wouldn't that make it like a monopoly? It's already a monopoly. It'll be a double monopoly in that sense. And could the regulators come after them? I mean, this will, it's like a winner takes all sort of a situation that's emerging if that scenario plays out.
Yeah, absolutely. And this actually also as well goes into a wider trend that I think we're seeing here at the moment, which is that essentially sort of what you could argue is the equalization of content and time. And this also as well has implications, particularly when it comes to YouTube and its commentary about YouTube becoming TV and promoting content creators. Bear in mind the biggest single barrier to entry for the tech companies in terms of TV's advertising money is premium content. The
Mm,
tech company's model is not set up for producing that content. What would be an ideal situation for those companies is, yeah, in an ideal world, we all watched AI generated content. Yeah, or, as sort of what would be a halfway house would be content creators who don't have the bargaining power of traditional production studios and also as well a lot cheaper to cost. Those sort of two models, particularly the AI generated content model, would very much fit in with the business models of the tech companies. And so, what sort of you're seeing a push really across, particularly Meta and sort of Google here, or Alphabet as it's now called in the stock markets, is essentially this pushing of the line that all content is equal. It doesn't matter whether you get content from a content creator or whether you get it from a traditional movie or sort of television company. It all has equal worth. And in fact, time is sort of, it doesn't, there's no such thing as it were premium time. The attention economy is really about saying it's a very utilitarian sort of methodology, but essentially says your share of advertising time should equal your share of viewing time. It doesn't matter what content is watched, whether you're watching a 30-second AI video or you're watching a 2-hour movie, all content is the same. And so sort of in this background of, again, it comes back to sort of this fight for advertising money, but also as well, there's the sort of very concept of content, premium content, is also being redefined here as well. And as I say, on the one side, you would have the traditional media companies whose main moat is this premium content. And on the other side, you've got the tech companies who are very much looking, as it were, to democratize content. But really, what that involves here is essentially saying to people, it doesn't really matter what you watch. There is no real sort of quality element here.
Gotcha. So, Ian, since you're a historian, I'm going to just sort of dial back a little bit and ask you, over the last 20, 25, 30 years, at what points did you see increase in spends in the media industry, overall spends? At what points, and what were the factors that led to increase in media, the media industry to sort of grow? And it's a combined media spends I'm talking about. Any
Yeah.
extrapolations?
Sure. So, I mean, yeah, apologies for interrupting. I mean, usually advertising sort of has been, you know, really been driven by economic factors, GDP, what's happening with there. Sort of, so in the US, you might have got around 1.2, 1.3% of GDP being spent on advertising, would be low in other countries. Yeah, across the board. And that model pretty much, I think, yeah, argued held into the 2000s, yeah, into the early 2010s as well. What you've seen in global advertising markets, certainly sort of post-COVID, but arguably you could see it in some of the trends before, was that actually now advertiser growth seems to be running ahead of GDP growth. And I think probably what you've got there is really down to what's happened with the tech space driving things. And I think you've got three factors that drove a lot of the advertising spend over the past 10 years. You had the rise of SMEs. So SMEs who essentially advertised on Google and Meta in particular. And pretty much what they did was transfer sort of what they had previously spent in shop costs, property costs over into advertising. You then had private equity, which in an era of 0% interest rates was investing heavily in companies and encouraging them to grow. So therefore spent on advertising as well. Give one example, sort of in the UK in 2021, around 22% of all linear TV ad spend came from online born firms, not just the tech giants, but actually the biggest spenders were firms that literally their business models hadn't existed 5, 6 years before. So
Okay.
certainly sort of that had been a big driver. And over the past couple of years, it's Chinese e-commerce firms who have been exporting to North America, Western Europe, have also been spending aggressively on online advertising as well. So you could see there that the advertising growth rates for the online giants has been sort of double digits, consistently double digits post-pandemic on there. Traditional media has been, low single digits, whatsoever. But the overall advertising market in terms of its growth has probably been around high single digits, mid to high single digits moving forwards, which is ahead of nominal sort of GDP. Now, sort of, I think one interesting trend that you're seeing here is increasingly, I think you've got two advertising markets. If you want to look at it globally, you've got the traditional advertising market for the big advertisers, where it's still very much influenced by those macro trends. How much they spend on advertising, it's impacted by what the consumer is doing and so forth. But also as well, and you think of it as an iceberg, and those traditional advertisers are the sort of the bit above the surface. You've got a much larger mass underneath, which is SME advertising
Absolutely.
spending. And depending on what my view is that you're probably looking roughly, if you look at the results that come from the online companies, you're probably looking at maybe around 65, 70% of all global ad spend been now SMEs. It's not just Google and Meta, but it's also, for example, the e-commerce retailers on platforms such as Amazon. And there, that spending is increasingly disconnected from what you would think normal economic conditions, because quite frankly, for those sort of smaller companies, if they are not on the internet, if they're not advertising on the platforms, then consumers just they just can't buy their products. It's essentially life or death for them whether they actually advertise on those platforms. And I think sort of with the second category, what that means is they're very much more beholden to the online companies than certainly traditional advertisers are. So my feeling is that certainly in that second part of that market, that will continue to grow strongly. And but as I say, it may not be driven by what we think is the normal conditions of just strong or weak economic growth. It's just simply those SME firms need to be on those platforms to survive. And quite frankly, they will take pretty much any price that they have to, or pay any price that they have to, in order to stay on there.
Got you. That's an interesting point on the SMEs because that is the bulwark of all the bigger platforms, Meta and Google. SMEs is a backbone, and those guys cracked it, and traditional media or you know even broadcasters couldn't crack that market. Either they didn't have the technology or the means to do it. Back in the day, newspapers used to have yellow pages and classifieds. So in some form or fashion, they were addressing the SMEs, but the tech giants sort of changed the paradigm with the tech that they could offer. Um, just one question that I have right now is I was reading an article that you said that some things are inevitable, but they're often not true. Uh, uh, and sort of, I want to build on that. The example that you quote was book sales. That
Yeah.
in the era that everybody thought that everything is going to be digital, book sales are through the roof and probably at a high, a 20-year-old high. So can you just sort of double click on that?
Yeah, sure, absolutely. And a variety of different spaces. I mean, to actually go back to the online giants before,
Hmm.
their rise wasn't inevitable. I mean, what happened was really four factors that came together in the late 2000s and the early 2010s to really sort of boost their growth. So, what it was ultra loose regulation by the Obama administration in particular on those giants, an ultra loose fiscal policy in terms of zero interest rates that again encouraged sort of private equity spend firms to invest, but also as well allow those giants to grow. The rollout, particularly of 4G, sort
Hmm.
of by the mobile companies, because again, if you think about many of the services, the apps and so forth, like an Uber, wouldn't have existed if you hadn't have had sufficient phone coverage. And particularly when it came to the tech giants, I think it was strategic failures by the newspaper groups, the print groups in general, in terms of the threat to their businesses. And really, if those four factors hadn't have come together at the same time, then it's very likely that the tech companies will look entirely different now to where they would. In fact, the whole media landscape would look entirely different. I think when sort of if you look at the sort of examples now, I mean, talks about books, and it's absolutely right. Physical books. 15 years ago, people talked about the fact that we'd all be reading books on Kindle. That's not the case. Physical book sales are continuing to grow in most of the major markets sort of across the world. I think also as well, it's got implications, particularly here for TV. Yeah, again, sort of you go back 5, 6 years ago, the view was that streaming would dominate TV viewing, that essentially linear TV would be pushed out of the way. Now, sure, linear TV's in decline, but streaming has not sort of had the dominance in viewing that many people thought it would actually have. And this will have implications, I think, for the future as well. It goes back to the point that I said before. Human behaviors, sort of inherent human behaviors don't tend to change. What does tend to change is the way that they're expressed. So, people are always looking to be entertained, sort of on things. Now, what does that suggest? Yeah, sure that you could get I think you get the platforms continue to TikTok and Meta continue to grow. I think people will watch AI generated content just because, again, it goes back to this point that they do like to be entertained as well. But what it also probably means as well is that, again, the traditional forms of media that we've had in the past will still very much have a place in our societies. And in fact, arguably, could end up in a stronger position than what people currently think will be the case.
Got. So Ian, I've spent about a good part of my own personal career in the news industry, especially digital news industry. So I'm going to ask a couple of
Hmm.
questions regarding that. firstly, starting with newspapers. I mean, obviously, we know that in the West, especially US, UK, and all the developed markets, newspaper is in a steep decline. It probably doesn't exist. I don't know. It's almost on the verge of extinction. India is still sort of floating around. It's still not, those newspapers haven't disappeared. Maybe the viewership has come down, but uh, you think the newspapers death is inevitable, or it's one of those things that don't say, don't shout out before it's over.
No, I don't think it's inevitable. I mean, you've only got to look at the New York Times, I mean, which reported their Q3 numbers last week and actually beat expectations. Yeah, significantly beat expectations on both in terms of the growth of their subscribers. Digital advertising revenues are up 20% year on year. With things, and also as well, what you're seeing there is a very successful strategy around bundling their products. So people are not just going it for the news, but also as well things such as recipes and crosswords. And I think that really sort of comes back sort of to feed this into some of the points we discussed before. Inherently what people want is they want good content. They want content that they enjoy. What you could argue the New York Times has been very successful at is not sort of continuing to invest in content, and also as well having products that are appealing to its customers. And also as well, it's been helped by the internet because the internet has enabled it to essentially now have a global audience, whereas before it's very much concentrated within the US. You could argue the Guardian in the UK, for example, that hasn't gone down the sort of subscription route, but certainly in terms of a global audience, has also built up its sort of revenues as well. The Telegraph in the UK again has had a very successful line in terms of subscriptions, the FT and so forth. I think sort of where with newspapers they went wrong, and it sort of feeds into this question of what will happen in the future, was their strategic sort of decision making, of certainly in the late 2000s, early 2010s, was by and large abysmal. On one hand, they saw declining ad revenues. So what do? They cut costs. Particularly in areas such as journalists. What did that mean? The quality of the content went down, and therefore people decided not to buy. So it became an accelerating circle for many newspapers. If you look at the online experience now, and I'm speaking sort of somebody who looks at the UK newspapers, the online experience is extremely poor. There's so many ads that puts people off. They also, as well, allow their content to be pretty much controlled by the online giants. Their view was that
Yeah.
they had to replace sort of analog pounds with digital pennies. And because they took the view that their decline was inevitable, well, it became self-fulfilling. So they locked themselves in to playing with the online platforms and effectively become reliant on those online platforms to provide them with new subscribers. But of course, those online platforms were really interested in taking the revenues from newspapers. So you had this sort of relationship where, quite frankly, the newspapers, they were locking themselves closer and closer in with a partner who, at the end of the day, had a very, very strong financial interest in of making sure they became weaker and weaker.
Yeah, it just sucked them
So
out.
exactly. And so the newspaper groups that have thrived, the Axel Springers, the New York Times, the Telegraph is doing well as well. You look at the FT, has a good subscriber base. The key here on the Wall Street Journal, the key here is very simple. It's having great content that people want to watch. How you distribute that content, how you bundle that content, I'd argue that, going back to the sort of war historian analogy, that's more really about tactics and operations. But the key policy and the strategy for these sort of newspaper groups should be to produce great content, because that's what people want. And if you produce great content and you make it a great user experience, you will find that people will come to you.
Absolutely. So, in just another follow-up question is, from your vantage point of view, sitting in London and talking to private equity players and investors, generally, what is their view in India as a market? I know you told me about low ARPU and all of those, but they think at a
Mhm.
macro level, any thoughts you want to share? Because the India M&A field is sort of, the entertainment industry or the media industry is poised for a healthy growth. But those are all the internal studies that we see. But from a different lens, how do you see it?
I think it is obviously a great opportunity. Sort of it is the one liner. When you have a population of over a billion, then there are going to be there's going to be many companies who are looking to the market and saying this is potentially a huge growth opportunity for us. You've got some of the media players have been long established. For example, the advertising agencies in the country, WPP, yeah, it's still, despite its problems, still continuing to show growth in Asia, in India, and it is sort of probably the bright spot for that group at the moment. So there was a realization that India could be a very valuable market. At the same time, and to go back to the point that made before, many Western companies, particularly US companies, have tried to break into the Indian market and have not found it as easy as they thought. Yeah, and have either scaled back their operations or have like Disney did with GeoStar, have become a minority partner within there. Now, some have obviously invested. Amazon, for example, obviously made its investment in a MX, and you've seen you do get some who are sort of thinking that the market potentially has extra growth. What I would say is there is still I'd say the overall view is that the market potentially has huge opportunity, but for many investors, what they sort of think about are the rules and regulations, the potential difficulties on a day-to-day basis, the legal system and the implications there, and what that means. You know, things like retrospective taxation, which you've seen, for
Yeah.
example, in the Volkswagen case. That's been of a major issue as well. So there are various issues. I think certainly one big bright spot that you're seeing at the moment is what's happening with data centers. I mean, you've had Google talk about $15 billion investment over the next 5 years. Amazon and Microsoft are making multi-billion-dollar investments as well. And again, India's geopolitical position also makes it attractive as well for many of these tech firms to invest in the country as well. So I think there is on there, I would say on the tech side, things are still very positive. I'd say on the media side, certainly for advertising, people are quite positive on the Indian advertising market. But again, I think for many Western firms, they are still trying to work out how is best to work in the country.
Got it. I just read there was a recent news article about Google and WPP having a $400 million kind of a deal. Any thoughts, any comments on that? How are these two companies sort of trying to do the dance with each other?
Yeah, well, I mean, if you step back and look what's happening at the moment, you only have to look at what's happened with the WPP share price, which has collapsed. Yeah, and again, they had a profit warning recently. So greater pressure there on the new CEO to come in. What WPP, certainly with WPP Open, has made a bet on is it can target the SME advertising market and look for that to fuel growth, because ad agencies haven't really been able to break into that market. Their business model traditionally has not been, quite frankly, it's not been able to cope with it because it tends to be quite people intensive, and agencies just don't have the resources or the inclination to go into that market. Now, AI, you could argue that AI could very much change things when it comes to penetrating the SME ad market. I think you will see more ad agencies look to target revenues there. I think specifically with WPP, you would argue here that, you know, with a partnership with Google, it could be argued that they're coming from a position, WPP is coming from a position of weakness. Yeah, the Google partnership, I would say, is now one of the core components for what investors are thinking could lead to recovery in WPP. And so, in that relationship, it gives a lot of power to the other party, which is Google, which, if, for example, it was to say, maybe we're walking away, or maybe we don't see this partnership being as important as has been made out, could have a detrimental impact on the WPP share price. So I think it's interesting. we'll see how it develops. But I'd have sort of two of other sort of questions in my mind. The first question is, Google obviously relies on SME ad revenues. Is it
Absolutely.
necessarily going to let WPP do anything that sort of impacts that? The second thing is that WPP is, depending on whose numbers you look at, number one and number two when it comes to media buying globally. Yeah, and Google is trying to sort of push the line that YouTube is TV and to take TV advertising budgets. So whether what it does in WPP Open does that sort of cross over into perhaps suggesting to WPP that, yeah, maybe they could help out in terms of YouTube. I'm sure, for WP, they all ad agencies look after the best interests of their clients, but having worked in finance for so many years, it makes you a cynic. And certainly, if I was Google, I'd be thinking about the potential implications there for what I could do with YouTube, given WPP's sort of distribution strength in media.
Got you. Yeah, that's an interesting point you make. I was reading in another article by you about how the tech companies engage with the CEOs to sort of have faster decision making,
Mhm.
as opposed to agencies, or other companies. You want to dial up on that with some examples of how the CEO is important in the decision making.
Oh, absolutely. I mean, CEOs and CFOs at the end of the day, they make the ultimate decision in terms of advertising spend. So if a board don't believe in the worth of advertising spend, then they won't. They're just not going to put in the investment. The good news is that I think certainly since the inflation crisis of 2022, 2023, and the fact that many companies in their conference call sort of turned around and said the reason why we're able to get such big price increases through to consumers, much more than we expected, was because of the strength of our brands, means that for both management and investors, brand strength, advertising strength is actually now seen increasingly as a key strategic priority and not just a cost. And that's a big plus. It's a big plus for the global advertising industry. The concern is, though, is that essentially, certainly in the world of agencies and marketeers, that they don't speak the language of the CFO. They don't speak the language of the board. They don't necessarily connect sort of what advertising does and how it translates into extra revenues, profits, and an increased share price. I think the tech companies are very good at that. And I think, to give you one example of that, go back to what we talked about before with Mark Zuckerberg saying, look, we can actually, if you give us your credit card details, we can essentially produce your ad, we could distribute it sort of across platforms, we can run it from start to finish. That message is not targeted at the CMO, it's targeted at the CFO and the CEO, because it says we will make this process a lot more efficient, we will make it a lot more effective, and therefore we will increase your return. And the sort of language that I'd say with the tech industry in particular, what sort of one of the underlying great successes they've had is that what they've done is they've changed the sort of dialogue and our understanding of advertising into ways that very much advantage them when they're fighting for a share of advertising. And that's such as things of saying, firms using tech companies' attribution models, without sort of questioning their impartiality. It's whether the language that is used around return on investment, and again, how that favors sort of particularly performance marketing spend, which again favors the tech companies as well. But also, as well, when again, the sort of promise of saying if you spend X, you will get a return of Y. That's the message that really appeals to boards who, quite frankly, don't have the time or the inclination to go into all the details of advertising. And so I think, what the tech companies have done very well is realize that boards theoretically recognize that advertising is very important, but practically they don't really understand the technicalities.
Gotcha.
And what the tech companies have done, which is, which if you think about it as an engineer, is a natural strength, has come along and said, that's fine, we can fix this for you.
Got
And
you.
human nature as it is says, that's great, just, deal with this problem.
Perfect. So basically, CMOs need to learn financial management and have a great understanding of finance and talk to in the same language with the CFOs and CEOs.
Exactly. I think
I know
that core
we are
attribute.
so I know you're under a time limit, so I'm just going to wrap up with a couple of more questions. Recently, about a month back, there was a news article about Dentsu winding up its international operations and focusing on Japan. Any views on that? Why they might do that? Anything that trigger that move?
Sure. Well, I think it's been something that's been going on for a couple of years. I mean, if you go back sort of to when Dentsu bought what was then the Aegis of media assets back in the early 2010s, the strategic rationale was they wanted to accelerate of growth in Dentsu. So Japan at that time had a very of stagnant advertising market, a stagnant consumer economy. I mean, they were still suffering from the problems of the 1990s with there, whereas Aegis international assets were actually growing well. So, what those businesses were seen as, and things such as Merkle, the technology arm, they were seen as accelerating the growth within the wider Dentsu business. If you look at the situation now, that's entirely reversed. It's the Japanese operations of Dentsu that have got the faster growth, and the international assets that actually generally have shown either low growth or flat or even in decline. And so I think, and this has been going on for several years. This is not just of a 1 year pattern. I think a combination of that. I think also as well that if you look at the management changes that have gone on throughout the whole of the Dentsu international operations over the years, you could argue that there is perhaps a cultural difference there between of the Japanese headquarters and also as well the international assets, and that has caused operation of issues there. And I think also as well that particularly in the wider agency space, if you look to see what's happening, there's polarization that's happening. You've either got the big giants, certainly Publicis and Omnicom. WP is a question mark of where it will go, or you've got very specialized independent agencies. Where do those mid-size agencies sit? And I would include within there Dentsu. It's got global capabilities, but it's not obviously as big as the Publicis and the Omnicoms on here. So I think that talk is credible. I think it's certainly a possibility on here. And I think one issue for Dentsu will be whether they actually believe there's any chance of a potential turnaround here. Japanese companies don't like to make embarrassing decisions that can be seen as embarrassing on here, and I think that may also influence things as well. But yes, generally, I see it as entirely possible that Dentsu could sell its international operations within the next 12 to 18 months.
Okay, got you. Just before we wind up, there's one last question, and again, coming from one of your articles I was reading, is the holding companies, the bigger holding companies, focus more on the media side of the business as opposed to the creative side of the business, and you argue that that's not the right way to do it. Can you just sort of elaborate on that?
Yeah, I mean, it's not. I think that there does need to be a focus on the media side. And the fact is that media still generates the bulk of the profits for the major holdcos. So they can't do without media. The point in that article was to say that actually, where I think one of the big strategic mistakes that the holdcos made was almost as it were to make creative work a commodity. To really de-emphasize it. Yeah, and I mentioned that article when I was an analyst in the late 2000s, been at one investor presentation by one of the major holdcos, where they were talking about all the focus been on media, that media was growing so fast and creative almost was presented as a necessary evil that needed to be done, but didn't generate any profits. And I think that has come back to bite the industry, because the problem is that what it effectively meant is that if the agencies didn't see creative as worthwhile and worth paying for, neither did the clients. And
Got you.
now you face a situation where potentially with AI, there's an argument that a lot of media buying and selling can be automated. And so, yeah, what I would say is that for creative, my view is that creative actually should be recognized. It does create a lot of value and it should be recognized for that. An agency should get remunerated for that high value work. And again, I go back to the 2022-23 inflation crisis. That was a vast and planned experiment showing to many companies that brand strength was absolutely critical to their pricing power and their overall financial performance. That brand strength was built by agencies. That proves that creative really has sort of a huge impact on business outcomes. But the problem is that clients have got so used to actually not paying for large amount for that creative that then this just creates a spiral of problems, of course, because if it's not financially rewarding for agencies, what then do they, what do they do? Do they they probably put less sort of resources into it. You get sort of fewer talented people coming into the industry
But that's kind of
and so on.
counterintuitive because memorable advertising is what people remember, right? All of us remember the great
Exactly.
ads, and that's how it leads to purchase and brand recall. But what you're saying is some of the holdcos are not investing as much or not giving as much as importance to the creative aspect. That sounds a little strange.
Yeah. Well, I think again, it's follow the money.
Yeah, for
The
the
money has been in media, yeah, and
absolutely.
creative it hasn't. And that's that's the simple reason why that's been the case.
All right. Well, yeah,
But the agencies could turn that around.
oh, really? Okay. Okay. Yeah, they could turn it around. They could sort of put more emphasis on the creative part, because in this AI world, I think people don't want a synthetic ad to come. They want a human person to create an ad which reflects emotions. Otherwise, it's just a synthetic ad that comes over there. Uh,
Well, it's very funny at the moment that you see of one of the big topics in ad land is the whole thing of the Coca-Cola ad, the AI generated
oh
ad, and
yeah,
whether it has, now what I would argue with that is that that's probably an example of a firm that can get away with using an AI ad because Coca-Cola is so well known with such a history. Yeah, and its brand strength has been built up by over so long that quite frankly, creating an ad, what it just needs to do is remind people that it's there. And when
absolutely
it puts through a price increase of 5 to 6%, just get people to sort of accept that. And so you don't, I think in that example, you don't really need something that is going to be absolutely amazing or fantastic. What you just need is just to remind people, yeah, let's go out and buy the product.
correct.
I think though, but their ability to do that was built on the back of decades and decades of investing in great ads. And there are
Absolutely
very, very few firms that have that sort of brand strength that Coca-Cola has.
perfect. Well, yeah, I know you're under the clock, so we could keep on talking for long, but well, it was pleasure having you on my podcast, and well, thanks for your time. And then hopefully, maybe back in the future again, we'll probably do a round two of this conversation.
Oh, Galton, I'd be delighted to, and it was a pleasure to be on here as well. So thank you very much for inviting me.
All right, thank you.